I'd like to first introduce our first panelist, and that's Ms. Jing Ulrich. Jing is JP Morgan's Managing Director and Chairman of Global Markets China. She is responsible for covering the firm's most senior global clients across all asset classes and for maintaining relationships with executives at the helms of China's leading enterprises and government entities. Educated at Harvard and Stanford universities, Ms. Ulrich is one of the most prominent advisors to the world's largest asset management companies, sovereign wealth funds, and multinational corporations. Her views influence the allocation of trillions of dollars of assets. She also serves as an advisor to Chinese institutions seeking to invest overseas. Jing Ulrich has received numerous industry accolades for her work as a China watcher. She was ranked as one of Fortune magazine's 50 most powerful global businesswomen for the past 3 consecutive years, and one of the 100 most powerful women of the world in 2010, citing her as one of the 20 youngest global power women. Because of Ms. Ulrich's in-depth knowledge of the China markets, Jing has been an important figure in shaping the international community's approach towards investing in the world's largest and most dynamic developing economy. She established JP Morgan's Hands-on China series, which has become a leading forum for views and research on the key issues in China's economic transformation. The series has hosted hundreds of corporate leaders, industry experts, academics, and government officials. Ms. Ulrich is also credited with establishing the world's foremost China investment forum, almost as foremost as the Australia-China Youth Dialogue, which really attracts thousands of business and government leaders from around the globe. In addition to her duties of JP Morgan, Ms. Ulrich is a busy person who travels almost 75% of the year. She serves as an independent director on the boards of GlaxoSmithKline, or GSK, a leading global healthcare company, which she's just returned from Delhi for a board meeting, I understand, and the Italian luxury goods firm Ermenegildo Zegna. I apologize for my horrific Italian. Thank God I studied Chinese. Without much further ado, Ms. Jing Ulrich. Thank you, guys.
Thank you very much, Henry, and thank you very much, Professor Lin. And it's a great pleasure to be part of this fantastic forum with so many young, emerging global leaders of tomorrow. And it's also my great honor to be sharing a stage with Professor Lin. I don't have any prepared remarks. I thought I'd just use the next 10 minutes to share with all of you some of our latest thoughts on China and China's role in the global economy. Henry gave a very kind introduction, but the most important thing you didn't mention is that I grew up in Beijing. This is my hometown. So it's really quite remarkable. Each time when I return to Beijing these days, the city looks very different. Every time, traffic is getting busier, new buildings keep on popping up. But when I went to the US, when I was a teenager, of course, China was a very different world. Look at the Chinese economy today. It is already the second largest in the world. I was in Japan last week for the World Bank IMF conference. And interesting comparisons are always drawn between China and Japan. And back in 2010, when China surpassed Japan to become the second largest economy in the world, the two countries back then basically had the same size GDP, $6 trillion US. Today, China is, I think, at $8.5 trillion. Japan didn't grow in the last 2 years. It is still at just over $6 trillion. So it's remarkable to see the pace of change in China, of course. However, we do have some challenges. This year, 2012, will be quite different from past years in that the actual GDP growth rate will be very similar to the government's target. In previous years, the government would always set a target, but the actual growth rate would be a lot higher, 3 to 4 percentage points higher than the target. This year, as we all remember, back in March, Premier Wen Jiabao set a target of 7.5% for GDP this year. I think we are going to end the year with 7.5 or 7.6. So clearly, in the last 9 months, 3 quarters, we've had a deceleration in the Chinese economy. We went from 8.1% in the first quarter to 7.6%, third quarter 7.4%. So this is quite unusual for China to have sub 8% growth. There are 2 key reasons for the current slowdown we're experiencing. The number one reason is really the external economy, which is growing at a very anemic rate. Europe is not growing. It won't grow for the coming few years. The US economy is growing at below 2%. China is the largest exporter in the world. So therefore, Chinese exports have indeed been affected by the slowdown in the external sector. And this year, exports will not contribute to growth. Net exports actually will be a drag on growth in China. The second reason for the slowdown we're seeing, I think perhaps has been engineered by the government. One of the key reasons for the slowdown is the property sector. In the last 12 months, 18 months, the central government has introduced a host of measures to slow down the property market, especially the price appreciation that we've seen over the years. So the restrictions on purchases were introduced back in 2011. We then had pretty much a slowdown in transaction volumes, and prices until recently had been falling as well. The property sector is of critical importance to the Chinese economy. On paper, if you read the economic statistics, it's about 10% of GDP. However, the property sector is much more important than the stated 10% because it has a huge impact on at least 60 other industries, from commodities to home appliances, even consumer sentiment. So I would say the slowdown in the property sector goes well beyond the 10% of GDP number that we all see in government statistics. So the combination of the external slowdown and also government-engineered slowdown in key industries such as property has caused the current slowdown we're experiencing. So what will come next? Of course, we're all keenly watching the leadership transition, which is coming up. November 8th, we have the 18th Party Congress. Next March, we have the National People's Congress. So during the next 5 to 6 months, you have a new group of Chinese leaders emerging, taking office, and really taking perhaps more new measures to try and boost the economy. However, I think this time around, we're going to see quite a muted recovery in the Chinese economy. Back in 2009, we all remember the economy experienced a V-shaped rebound after the 4 trillion yuan program was announced, after a lot of money poured into the economy. This time around, I think the government is acting in a much more prudent and nuanced fashion in that they will not introduce extremely aggressive measures to boost the economy. I would also say the economy is of such a big size now. It is very difficult for an economy that's $8.5 trillion to grow at 10% per annum into perpetuity. So therefore, growth rates will come down. But that doesn't mean China's prospects are not bright. I would argue in the future 5 years, 10 years, we will see a very important rebalancing in the Chinese economy. China will continue to be a major buyer of natural resources, raw materials. Chinese consumers will have more spending power overseas. Sectors that were not important in China before will become important, such as travel, tourism, internet, education. So I think we have some powerful underpinnings for the Chinese economy for the future years. But China will grow in a different way from what it has grown in the last 10 years. Last 10 years were really about exports and investments. The future 10 years, I think, will be about the Chinese consumer. Look at the Chinese consumer. I just came from India, from Delhi, where I had a few days of board meetings with GlaxoSmithKline. Chinese economy is much bigger than India's. India's 1.7 trillion GDP. But these are the only 2 countries in the world where the population is over 1 billion people. But India is very different from China in that consumption accounts for 70% of GDP. China, consumption roughly accounts for, 35% of GDP, under 40% for sure. So I think in the future years, the consumption sector in China has huge room to grow. We have urbanization as a very powerful driver for growth. Urbanization rate in China improves 1 percentage point per year. Today we're at 51%. Next year we'll be at 52%. And it won't stop growing until perhaps we reach developed market standards, i.e. 80-85%. So there will still be another 30 years at least of urbanization that will help drive growth. And importantly, when people urbanize, they earn a lot more. Incomes in the urban areas are 4 times higher compared to the rural areas. That's on stated government numbers, but actual numbers may be 6 times, 7 times, who knows. Also, income growth. Income growth is still very rapid despite the current economic slowdown. And importantly, because I'm on the board of an Italian luxury goods company, the correct pronunciation is Ermeni Giudozania. Men's luxury goods are right downstairs here. You can pop into their shop and have a look. But China is a very major consumer of luxury goods. As I travel to France and Italy for board meetings and other business, it's remarkable to see how many shops are filled with Chinese tourists and Chinese-speaking shop assistants. You really need Chinese-speaking staff to really help the incoming Chinese tourists. And I would say Chinese consumers have huge spending power, not just in luxury goods, right? We all know China now perhaps is the single largest market for luxury goods, having surpassed Japan. We're talking about men's fashion, ladies' fashion, watches and jewelry, pretty much everything across the board. Even in mid-tier consumer markets, you have a lot of growth drivers as well. Incomes are growing rapidly. People are urbanizing. So, think about the staples people buy, whether it's food people eat, daily consumables, and again, huge potential. Another area which I'm very bullish on, and I hope some of you maybe in the future choose to find a career in the service industry, whether it's education, healthcare, IT services, tourism, travel. I think all these areas have huge potential to grow. I mean, just look at healthcare. I always advise my global clients, when you think about investing, okay, investing is not a complicated business. It is actually a pretty simple business. Or my job is try to make something that's seemingly complex, simple. So when you buy something, okay, you want to, I'm talking about buying equities or stocks now, okay? So you want to buy something or a company that is supplying something, a service or a product that's in short supply. Demand is strong, supply is not enough. You don't want to get into a stock or a company who's supplying something that's already too much in the market, so you don't have any pricing power. So this is common sense, right? You all have PhDs and 3 master's degrees, I think I hear from Henry. So, what's in short supply in China? Just give you an example. If you want to get a doctor's appointment at one of the leading hospitals in China, you have to queue up at 2 o'clock in the morning, right? To be able to see that doctor at 8 o'clock. If you show up at 8, no luck. So that's one area. Medical services, healthcare, I think really are in short supply, but the demand is very strong. Look at the size of the Chinese population. 1.3 billion people, 22% of global population resides in China, and the population is aging. So healthcare, pharmaceuticals, I think has great potential to grow. Education. I have a niece who is half American, half Chinese. She's 6 years old. Her parents, my sister and her husband, are paying for her preschool education. I think they're paying more than what I pay for my Harvard education. So I think, education, again, is good quality education in short supply. So, I think you want to think about when you choose a career, when you buy a stock, when you choose to invest in a sector, perhaps think about areas where you have a shortage of supply and a surplus of demand. And that's where you're going to do very well. So, in a nutshell, I think the Chinese economy is indeed experiencing a degree of moderation. But I think we can avoid a hard landing. Importantly, I focus not just on the quantity or the pace of China's growth. I focus very much on the quality of growth and where the growth is coming from. In the coming 5 years to 10 years, I think the growth will come from consumption, services, and that's where you should make your bet. Thank you very much.